Hello and welcome to today's premium account market update for the ASX Top 50 for April 2020. Any individual or reading should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances, and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hein, Managing Director of Investor Signals. I have 24 years of experience in the financial services industry and a licensed securities and derivatives advisor. The topics for today: we look at the macro update driving equities, we roll through the ASX Top 50 stocks, we look at the impact on FY20 earnings and where fair valuations are for the market and the individual stocks that we cover. We look at the technical trends, portfolio allocations, and conclude with a short-term market outlook. Investor Signals provides a broking account service. We have technology to focus on our model portfolios, which include ASX Top 20, Top 50 and Top 100, as well as the US S&P 100. We also focus on an ASX and US high conviction portfolio, which is based on the ideas expressed on the daily blog. We also have a new model portfolio which is based on the iShares ETF, so it's where our algorithm models select out of the available iShare ETFs which funds or ETFs should be in your portfolio at any point in time. And if you'd like to have a look at the performance of that, please reach out and contact me or send me an email. Also, with inside the broking account service, we can run an independent portfolio where we work in partnership with you to execute orders that we agree on jointly, good opportunities in the market at any point in time. All within the same account, we can utilize derivatives to enhance portfolio returns, which can include covered calls or buying put options as protection. All those tools are available to us in going both long and short within equities. To open an Investor Signals broking account, please call me on 1300 614 002 or drop me an email, leon@investorsignals.com. Okay, looking at the macro picture driving equities, base case is analysts are forecasting anywhere between 10 to 30% earnings fall across the board. The market has been very optimistic in the rebound back, in particular in the US and in particular in the technology sector. What we're looking at on screen is the Nasdaq. The rally back in the Nasdaq appears to be a little overdone and has all the hallmarks of a bear market rally. So we're cautious at the moment as the index runs into resistance at around this 8,600 level. We're watching closely the short-term indicators, which have turned negative, and for the moment we're taking a cautious view on the market until such times we see the price action re-establish a more bullish pattern. In the context of the Australian market, the XJO, the rebound hasn't been as strong, but we're still cautious on the Aussie banks and some of the industrial companies. But there are opportunities in the market, and we'll focus on those as we go through today. So looking at the XJO, we've got overhead resistance at approximately 5,530 points, and we're seeing the short-term indicators turn negative, and we're expecting the XJO to struggle to push back up through that level. But obviously that's something we just reassess as the news flow changes in the market. But we'd expect to see the March quarter earnings in the US not be as bad as maybe what people may first fear. In reality, there was only about 4 weeks at the end of the quarter that really were materially impacted by the implications of COVID-19. But certainly the June numbers, when we see those, they're going to be terrible, and have analysts allowed enough when they're factoring roughly 20% fall in earnings for that impact for the June quarter? And then how quickly does the global economy fire back up again, and how many people go back to work? What kind of implications does that have for the earnings, revenue, PE valuations, etc. So that's what the market's grappling with at the moment, and we'll look at sort of where the best opportunities are. So click on the watch list, go down, select ASX Top 50. We'll get the greatest percentage gainers to the top for today. Organise in buy order, and let's move through these. So again, we're going to be focusing on the stocks under buy conditions and then moving into the ones under sell. So oil search, so we comfortable with Oil Search. The oil's rallying off these lows at the moment. They're oversold levels. Our preference is Origin and Santos over Oil Search. Fortescue, we quite like Fortescue, BHP and Rio, although iron ore has moved from sort of the high 80s down to the low 80s, and there doesn't appear to be any substantial reason why I would see a major pickup in iron ore demand over the next 12 months. So the dividends are attractive, I think, relative to other areas of the market where the dividends are going to come under pressure. But there's maybe not the catalyst to really cause these names to rally too much higher in the short term. Origin Energy, so looking at support there at 450. I posted a post on the blog today just to say, look, support at 450. You need to run stop losses because there's no certainty that this sort of one-day bounce in the market or two-day bounce in the market for oil is actually going to materialize into a strong uptrend. But Origin, we quite like the fundamentals there, comfortable with the balance sheet, and out of the energy names, that's one to have a think about. BHP, I've just put support line there under the low at around $28, $29, and it's okay to be sort of long BHP as long as it holds above that 28. If we really see some selling in the US pick up and a BHP break below that sort of 28.75, you may want to sort of rethink the positioning there. CSL tracking sideways at the moment, but this is a name you want to keep a close eye on and buy on any weakness. A number of analysts have downgraded CSL's earnings growth. It does trade on a high PE, but anything sort of sub 300 to me would be an entry opportunity for CSL. Santos is the other name, so the two energy name preferences, Santos and Origin. Santos, you can see there that we've got the higher low formation at around $3.80, and buying it whilst it stays above that, we're okay with that as a positioning. Qantas will obviously be in the end be a beneficiary of the implications that Virgin's going through, but in reality, no one really has clarity around the demand for air travel and the time frame for it returning, so it's pretty hard to get too bullish there on Qantas. Computershare, we think that this actually finds support at around $11, so maybe it's a consideration as a buy right for portfolios. Ramsay Health Care just raised capital. The cancellation of elective surgeries has obviously had a material impact on their earnings for this year. That does appear to be starting back up in some limited capacity for elective surgery. Ramsay shored up their balance sheet at around $60, the stock's fair value, but don't see it doing too much on the upside there. Insurance Australia Group, again, support probably somewhere around this $5.50 to $6, but we don't see upside potential really there at the moment. Lendlease, given the backdrop of the market, we really like the Lendlease business on a sort of 2, 3, 5 year outlook, but just over the next 6 months, I think you still just need to be a bit cautious and look for some more good news in the global economy before getting too bullish there on Lendlease. Not doing it there in AMP at the moment. Rio, so as the case with BHP and Fortescue, we're comfortable that they're able to maintain the dividends, so from a cash flow standpoint, these remain attractive, relative to, say, banks and property stocks where dividends are going to get cut and likely discounted capital raisings, but we are mindful that iron ore's at the lower end of that sort of $80 price range that it's been in for a while. APA's just moved to shore up their balance sheet, raising capital, but at $11, that's full value. We don't see anything there. Again, it's suitable as a defensive income trade for portfolios, APA, but not one of our high convictions. We'd owned it at lower levels and it's back at full value. Mirvac, not doing there at present. GPT, look, I've put a support line under there at around this 350. Keep an eye on that. Watch the short-term stochastic indicator there. If you see that turning higher and you're just looking for a short-term momentum trade in the market, you may get a bounce. But I think there's some real question marks over, what the forward valuation for GPT is, given the impact that this is having on their business. Newcrest, so comfortable here owning Newcrest. I think gold up at sort of $17.50 a ton. You could an ounce, I should say. You can buy Newcrest here and sell covered calls, or just simply buy it and hold on and look for better production numbers and better profit numbers, coming through later this year as we see the benefit of that higher gold price. For shorter term traders, again, look at this momentum indicator. It's turned back up, it's positive, so as long as maybe that trends up, you could stay on the long side of a sort of shorter term intraday or day, 2 or 3 day type swing trade. Telstra should find support down here at around $3. Most global telecommunication companies are indicating that they're expecting about a 10% impact to earnings. Even if that flows through to Telstra, I think sort of anything sub $3, there's a good opportunity to enter Telstra. Coles, buy right. Coles and Woolworths, buy these companies and sell fairly tight covered calls, strip the dividends out, you're getting 8 to 10% cash flow. I think right at the moment Woolworths looks more attractive on just a short-term momentum basis than Coles. If we could buy Coles sub 15.50, I think you could get a little more aggressive there. NAB, we're cautious on this. I think the Aussie banks will cut dividends substantially, if not altogether. They will likely have to raise capital despite what they say, and on the 7th of May NAB report their earnings and they'll get a clear indication of what their provisioning is going to be for this COVID period, and it's probably it'll be the first of, I think, other sort of we'll see a provision allowance now, and I'm sure the damage will be deeper, and we'll see further provisionings in June to September period as well, but that'll be an interesting date. But for the time being, very cautious there on NAB. AZJ sub 425 is what I've been talking about on the blog, so we really want to sort of see this down into that sort of say 4 to 425 range before we look at buying AZJ. CBA, cautious there. Goodman Group, within the property space, this is attractive. Between sort of $12 and $14 is a consolidation range. So on any sort of days where you see weakness in the market, you can pick this up at sort of that lower bound there, closer to $12. There's a good trading opportunity because I think Goodman can look, and there's little visibility on earnings, but given Goodman's exposure to logistics centres, we don't expect it to be materially impacted, so they should sort of get through this. They came into it with low gearing, and their business model should be able to hold up okay. Wesfarmers, a little bit cautious on Wesfarmers, up at around this $37 level, so not doing too much there at the moment. Sydney Airport, support there maybe somewhere between $5 to $6, but again, not a stock that we're aggressive in. Caltex, we've seen the takeover bid pulled from the market at, I think it was $34.50 or something from memory. That's been pulled from the market. For the most part, they've identified that they didn't see any significant issues with their due diligence. So in normal economic times, we may see a revised offer or another offer brought forward. Cochlear, so we like the Cochlear. They've moved early to shore up their balance sheet, raising equity at $140 a share. So somewhere between this 160 and 180, we're buyers of Cochlear, and I'll keep you updated on the blog regarding that. Orica, so we like this name. Somewhere around this 1650 should find support. Medibank Private, hard to get excited about the health insurers, but maybe back down at around 250. There's some opportunity there to think about. Not doing anything in Dexus at the moment. Woolworths, so buying this and selling a covered call up at around $37.50, you're generating about 8% cash flow on a 12-month basis. So for superannuation funds looking to generate a cash flow yield, that's a strategy that I can talk to you more about if you want to ring the office. Westpac, again, not doing there at the moment. We think all the major banks are under pressure to the downside. We think Amcor was full value at 14, maybe back down at sort of around $12. We're happy to take another look at Amcor, but for the time being, I think that looks expensive given sort of the issues in the global economy at the moment. Aristocrat, again, a little cautious there, so not doing there. ASX, so this was a stock that was in our high conviction. We were very bullish this. It's rallied back to where we see fair value at the moment and see it mainly tracking sideways. But if you're looking for defensive sort of yield in the market, ASX is a consideration. QBE, cautious there. We think QBE, even though they've moved to shore up their balance sheet and raise equity, we think there's substantial problems, and you've got to be very cautious on QBE. Transurban, assuming dividend cuts this year at around $12, Transurban's full value for the moment. So, sentiment-wise, if the restrictions eased and people return back to work in the next month or so, I think Transurban will be a beneficiary of just improving sentiment. But there will be cuts to dividends both in the June and the December period. So I think the probability of it rushing back and being supported at $15 is relatively low. So we'll continue to revisit that. Macquarie, we're cautious there on Macquarie. See resistance up at around 105, and we think that Macquarie moves lower. Brambles, I'd warned up at around $12. Brambles is expensive. Maybe down at sort of $10.50 to $10. We could start to take another look at it on the buy side, and I'll update you on the blog as to the timing around that entry. Sonic Healthcare, so keep this one on your list. I think this sell-off creates a buying opportunity. Maybe it pulls back to around this sort of $23 level, but I would see that as a buy on the dip. James Hardie, not doing there at present. Woodside Petroleum, not doing anything there. Preference is Origin and Santos over Woodside, but we just flagged that the resistance there at 22.50 and expecting it to continue to struggle below that. Stockland's not doing there at the moment, so we're concerned of the resistance there at around $3. We think it struggles below that. Suncorp, bearish here, so Suncorp and NAB are probably our two high conviction shorts within the financial services space. Vicinity, not doing there at the moment. The XFL, which is the index, I think we'll focus on the XJO for the purpose of today's recording. South 32, we got resistance there at around $2.10, and we don't think that South 32 trades back through that level in any hurry. ANZ resistance at $17.50, pressure to the downside. Treasury Wines, resistance there at around $11.50, continues to have pressure to the downside. Centre Group, resistance at $2.30, not doing it there at the moment. AGL, resistance at around $18. AGL's probably downside risks are fairly limited, so generally we don't want to be buying stocks under sell conditions, but if you're looking for a buy right in the market to generate income, you could run an at the money buy right over AGL to produce that sort of 8 to 10% cash flow. And there you are back at the beginning there with Oil Search. So just to recap, our concern for the market at the moment is that the rally back in the US is not supported by fundamentals. The market has rallied back in line with improving outcomes around controlling COVID-19 and optimism about a V-shaped recovery in the US economy. We think that scenario's unlikely, and we're more likely to see sort of an environment where equities need to be repriced for something in the order of at least a 30% cut in profit. And when you apply sort of a 16 times earnings to that, the market just doesn't support the current valuation. So our strategy is to have hedging in place in portfolios. We're long gold, focus on healthcare, select technology stocks where we're buying them on the dip, and running strategies to profit from sort of those more defensive names where we're selling covered calls and driving higher income out of them. So if you'd like to talk further about the strategy we're running in the current market, or you'd like to inquire or talk to me about opening an Investor Signals broking account, please either email or give me a call on 1300 614 002. Thanks for listening in.